How billionaires use debt to keep you poor. Most billionaires have the bulk of their wealth tied up in stocks. But if they sell those stocks, they'll owe a ton in taxes. So, instead of selling, they just call their bank. The bank gives them a low-interest loan, with their stocks used as collateral. If the value of those stocks drops, the bank might ask them to pledge more shares or add some cash to keep the loan safe. But in normal market conditions, this becomes easy money, a clever way to access cash without triggering taxes. Sure, they still pay interest, but the rate is usually far lower than what they'd owe in taxes if they sold. Plus, since they didn't sell, their stocks can continue to grow in value. If that growth outpaces the interest they're paying, the move is a no-brainer. They get spendable cash while keeping their money-making assets intact. Use mortgages to buy property. In November 2013, Blackstone's rental home division, Invitation Homes, bundled the rent from 3,207 houses and raised $479 million in a deal that was the first of its kind. This showed how the big players scale real estate. Here's how they do it, broken down simply. Borrow to buy homes. They take out mortgages to purchase a bunch of properties. Find tenants. Renters move in and start paying rent each month. Collect and manage rent. They set up a small company whose only job is to collect that rent and handle property expenses. Sell IOUs to investors. That rent-collecting company issues bonds, basically IOUs, and sells them to investors. The deal says, you'll get paid monthly from this rent money. Have a backup plan. If things go south, those houses are collateral. Investors can take them or sell them off. Use cash to grow. The money raised from investors helps pay off earlier loans and buy more houses. Refinance and repeat. When interest rates drop or property values rise, they refinance their old debt for cheaper debt, and start the cycle again. That's how large real estate empires scale: borrow, rent, refinance, repeat. Insurance float. Meet Joe, your average guy. He pays his car insurance bill every month, hoping he'll never have to use it. Meanwhile, the insurance company is collecting payments from thousands of Joes and investing that money for years before they ever have to pay a claim. For Joe to actually use his money, he'd have to get into an accident, file a claim, and hope it's approved. Even then, the payout might be smaller than he expects. Those monthly payments Joe makes are called premiums. Insurers collect those premiums up front. That's a liability, or in simple terms, a form of debt, because they'll only pay claims in the future. The gap between collecting premiums and paying claims is called float. And during that gap, insurance companies invest that float in stocks, bonds, or even entire businesses. It's one of the smartest ways to invest using other people's money, by companies with debt. Billionaires and private equity firms often borrow money to buy large, cash-generating companies, then use those companies' profits to repay the debt. This is called a leveraged buyout, LBO. Here's how it works: the buyer puts in a little equity, banks supply a large chunk of debt, and the target company's own cash flow handles the loan payments. If the new owners can make the business run more efficiently, sell off non-core divisions, and reduce debt, their small initial investment can multiply massively. It's risky, but it works often enough to make fortunes. Sell bonds to fund growth. In April 2013, Apple sold $17 billion in bonds, marking the largest corporate bond sale ever at the time. And here's the twist: they already had piles of cash. So why borrow? Because debt was cheap, interest is tax-deductible, and issuing bonds let Apple reward shareholders and invest, all without bringing foreign cash back to the US and triggering taxes. When your credit is stellar, you can borrow under friendly terms, keep control of your company, and still fund expansion, acquisitions, or shareholder payouts. Bonds are simply tradable IOUs that make it possible. Borrow to buy back shares. Sometimes a company takes on debt just to buy back its own stock. When that happens, the total share count drops, meaning each remaining share now represents a larger piece of the pie. Earnings per share go up, which often pushes the stock price higher. Founders and early investors love this because their ownership percentage increases without spending a dime. Since interest payments are a deductible business expense, the company can also reduce its taxes. And if the stock is undervalued, buybacks become an efficient way to use capital. Leverage the portfolio. You can also borrow from your broker to buy more stocks than your cash alone could afford. That's called margin. If your stocks go up, your gains multiply. But if they drop, your losses multiply even faster. Brokers set minimum equity requirements. When your portfolio value dips below that cushion, you get a margin call, and may have to sell your stocks just to pay the broker back. Billionaires use margin strategically, only when they see a clear short-term opportunity, and they balance it with safer borrowing elsewhere. The appeal is obvious: amplify returns. But the danger is real. Leverage can make small mistakes very expensive, and some of history's biggest losses came from over-leveraged portfolios. Build with construction loans. Developers don't show up with suitcases full of cash to build skyscrapers. They use construction loans to finance most of the cost while the project is still being built. Borrow to pay yourself. In 2010, the hospital chain HCA borrowed billions and paid a massive one-time dividend to its private equity owners, a big payday without selling the company. Lenders agreed because hospitals generate steady, predictable cash. And just a year later, HCA went public again, doing perfectly fine. The playbook is simple: borrow at the company level, send cash to the owners, and keep the business running. Let customers prepay. Ever heard people say that Starbucks is basically a bank? That's because of how they handle prepaid money. Customers load funds onto their Starbucks cards or accounts. In reality, Starbucks can use that cash immediately to fund daily operations. This isn't unique, many businesses do it. Prepaid memberships, deposits, and annual subscriptions all act like interest-free loans from customers. They get cash up front, recorded as deferred revenue, and use that money to pay for inventory, staff, and marketing. Gyms, airlines, hotels, and even software companies rely on this model. It locks customers in, smooths out demand, and gives a clear idea of what to build or sell next, all while using customer money to grow. The big picture. So, while the average person avoids debt, billionaires embrace it, using it as a tool to grow faster, pay less in taxes, and keep their assets compounding. Debt, when used strategically, isn't a burden. It's leverage, and that leverage is how the wealthy stay rich while the rest of us keep playing catch-up.